Hello and welcome to Moneycontrol. Investing abroad has become very popular in the last few years, especially among discerning investors and high net worth individuals, especially in the last 3 or 4 years. With the growth of options in terms of international funds and ETFs being available for all sorts of investors, and especially the growth of platforms, the technology platforms, the online investment platforms, and in the wealth advisory community, also more and more options are now available at the hands of investors to invest their money abroad. Investing abroad has actually come in the reach of the common man. I'm Kaizad Adajania, personal finance editor at Moneycontrol, and I have with me today in the show Unmesh Kulkarni. Unmesh, hi, how are you doing today?
I'm great. Thank you. Thank you, Gaza.
So, just a quick introduction of Umnesh. Umnesh is the managing director, senior advisor, and head markets and advisory solutions of Julius Baer in India. Unmesh is responsible for managing the firm's investment solutions and market platforms in India. So, Unmesh, let's get straight to the point. What are the 2 or 3 most important trends that you have noticed in people investing abroad in the last 3 or 4 years? I mean, we know that more and more people are investing. Mutual funds have also been a very, attractive proposition for investors to invest, in the US markets as well as the European markets, and now the Asian markets have also opened up in terms of options. But can you just elaborate on the entire investment landscape? Your most 2 or 3 most pertinent observations in terms of trends.
See, I think what's happening is, all these years, Kaizad, Indian investors tended to have a huge home bias because we all thought that we do the best in our own country in terms of returns. But now the gradual realization has also come that that's not the case. Global markets also offer a lot of investment opportunity and return potential as well. So, just to give an example, uh, in the whole decade, let's say from 2011 to 2021, the 11 years, the S&P 500 actually on a calendar year basis has outperformed the Nifty 7 out of those 11 calendar years. So, that apart from the rupee depreciation also, I mean, during this period, the rupee has depreciated by more than 4.5% per annum annualized. So that obviously has drawn the attention of investors. By and large, when Indian investors are looking to invest abroad, Kaisa, they are looking at growth because our fixed income returns are quite, I mean, barring the last 1 year or so, our fixed income returns are far more competitive. So obviously, investors when they invest abroad look at growth opportunities. Mutual funds certainly, ETFs also, and we also tell investors that if you don't know where to invest, first start with the S&P 500 itself. I mean that itself gives you the broad participation. But apart from that, we have seen investors in equities, for example, take up a lot of opportunities across the US markets because obviously that's the most liquid and the biggest market. Some bit we have seen people dabbling into emerging markets. Little bit they have also done in China, but obviously have got disappointed with China. So largely in equities, it's been going to the US markets. Apart from that, we have seen occasional investment in, let's say, some of the sectoral or thematic sort of ideas overseas. And fixed income does not take up much except for, let's say, some of the higher yielding. We have seen investors trying to lap up some higher yielding bonds globally. But I would say largely it's been equity oriented. Some maybe allocation to gold also happens through ETFs, etc. abroad.
And largely, Unmesh, you're saying it's focused towards US, because that's the market that most of us understand well. We use products of companies that are incorporated in the US. But you're saying that even other than US, there have been some, participation in the European markets and even the Asian markets also off late, right?
European, I would not say so much.
Okay.
It's more of, let's say, the Asian markets. Uh, Again, largely, I would say still US centric, or maybe diversified funds, which again have 70, 75% exposure to US. And even I would say some of the more savvy investors have also taken to investing in stocks. Also, there are some good quality
Okay.
businesses. I think your fangs etc also attracted a lot of money in the good years last 24. I mean, except for the last 12 months also, but earlier, almost for 2 3 years, there was a lot of interest. So broadly, there's been a lot of participation, both directly into stocks as well as indirectly through funds and ETFs in the US markets.
Okay, okay. So, Unmesh, at the start, you said that initially, there was, investors over here when they started their investments journey, they sort of bought Indian funds first, invested more of the money in domestic economy, and then, as the international markets and options opened up, they went international. But today, if a fresh investor comes in and walks in, whether he is a high net worth individual or an ultra high net worth individual or even a retail investor, you have quite a lot of options, not just in the domestic space but even in the international space. Okay, so Unmesh, my question to you is that, for such new investors who are coming in the markets today, would you recommend a portfolio of international funds from the word go, or do you still feel that, we have to first build a solid foundation of Indian funds in Indian economies, and then, maybe your fourth or the fifth or the sixth mutual fund could be an international fund? What's your approach for a fresh investor today?
Uh, Good question, Kazat. My suggestion would be first of all, try to know where you're getting into, and that would be easier with the domestic markets. See, this is equity investing. This is all about, of course, wanting to earn equity returns, but there is also commensurate equity risk associated, and a lot of it comes out of knowledge or the lack of knowledge also about investing. So, for a new investor who's wanting to create a portfolio, I would first advise to first get to know equities as an asset class itself, go through the ups and downs, the vagaries of the stock markets, etc., get some experience, and parallelly start then building a small allocation to international equities. While international equities sound very good, etc., I mean, or international markets, but if you're not familiar with them, in terms of their risk return profile, then there could be surprises. I'll just give you a couple of examples. Equity markets, for example, the risk return profile of developed markets and emerging markets are quite different. So in good years, for example, you do find emerging markets outperforming developed markets, but in bad markets, they tend to crack badly. And emerging markets, as of now, also you can see that they have underperformed developed markets. So if just one goes by past returns, one could be surprised. Secondly, even fixed income. If somebody is trying to create an asset allocation now, obviously the return profile of fixed income is globally is quite different from India. Here we are used to higher returns. There, obviously, in developed markets, you get lower returns in fixed income. Plus, fixed income tends to be more volatile, as mostly it's all mark to market there. And in fact, this last year or so, fixed income globally has given negative returns. So I think an understanding of the markets, a little bit of knowledge, a little bit of following the markets, etc., is very important. Get your hands into it first, the asset classes, try to understand that, and then get into unfamiliar territory by gaining some knowledge about it. So I think what's important is to build that experience first, and then diversify and add international investments in your asset allocation.
That makes sense. That makes sense, Umnish. Umnish, other than equities, I mean, I know you've spoken about fixed income also so far, but and of course, equity is, the most attractive asset class when it comes to investing abroad. But any other asset classes that you, as a wealth advisor, recommend your clients? I mean, I know that real estate, for instance, has been, very dear for most Indians, and now, there are so many countries that are offering permanent residencies if you invest in their real estate. People are having wanting to have a toehold in, let's say, either Dubai or Portugal, or London, or even the US. So is real estate or any other asset classes other than equities, do you look at as a wealth manager?
So internationally, if you're talking about, well, Real estate, I would say, needs to be looked at differently because it depends on which country, which location, and I think it can't be measured in the same measuring glass. Also, it tends to be far less liquid, etc., and you need to have a larger quantum also to allocate. Purely, if I look at it from financial investments per se, yes, there are options outside stocks and mutual funds and ETFs. For example, there are structured products, there are tracker certificates, etc., which track, let's say, the performance of underlying indices, etc., which investors can access globally, which are not necessarily available here. Uh, Also, bit of options on the hedge side. There are some hedge funds, etc., structured products, hedge funds, etc., which are also available. uh, so it's about managing your investments in a more risk effective way. You get more options to diversify your portfolio. As I said earlier, amongst alternatives, you've got again various options: gold, silver, etc., some of these precious metals. You have ETFs around them. Apart from that, now if you have a higher ticket, there are the unlisted options as well. I mean, you've got the through the fund route. Let's say private equity funds also are there globally, but that would uh, of course require a larger commitment in terms of ticket size. May or may not be available to a normal investor in the initial part of the LRS remittance, because that time the ticket sizes tend to be lower, obviously. So there are multiple options there.
Okay, okay. When it comes to equities, Unmesh, direct stocks or mutual funds or ETFs? I mean, what's your chosen vehicle?
Yeah, so I mean, all have their own merits as well as their the risks also associated with that. But purely in terms of it again depends on how familiar you are, how experienced you are as an investor. So if you are, let's say, starting your journey globally, I think the best way to do it is through uh, mutual funds and ETFs. Now, again, in mutual funds also, there's a huge number of mutual funds which are available there. So maybe start off with the pure index ETFs, etc. S&P 500 is there. Somebody wants to dabble into technology stocks, etc. Maybe the Nasdaq related indices are there. Of course, there is a relative risk associated between them, but beyond a point, then active management also comes into play. So there are several good funds also which are available. If one, for example, if one wants to play the healthcare theme or the IT theme, etc. If one wants to take thematic exposures, those are also available globally through funds, and it's far easier. Kaisa, doing it through funds, you get diversification as well as you get the thematic thing, rather than picking up a couple of healthcare stocks which may or may not necessarily
And
outperform. Or
also, Unmesh, the difference, correct me if I'm wrong, the difference between investing in stocks and investing in funds is when you invest in stocks, it goes through the LRS route, right? Or is that the case? Because you need to convert it into dollars and then you can buy stocks. And if you invest in funds which are available by domestic fund houses in India, it doesn't come under the LRS route.
okay,
Is that
now
also a difference?
yeah, so then let me come to that point, Kaisad. So what I meant was stocks and funds are both available through LRS. You can do there as well. But now in funds, you have the added advantage that some of these funds are available as what you call the global
Fund of
access
funds.
funds or fund of funds, or even some funds investing directly into global stocks. So these are the feeder funds or funds accessing global markets directly, but which are available here domestically. So
Yes.
you're absolutely right. That doesn't eat into your LRS quota, and there's a lot of convenience, Kaizad, around that. Sitting out here like any of the mutual fund, you can invest in those funds and start your journey like that. So the easiest way to start your international investment journey is to take some exposure into international investments through the feeder funds out here. And I'm sure investors will have their own advisors or wealth managers who can guide them around that. We also have a lot of investors who invest through some of these feeder funds internationally. ETFs are also now available. Some ETFs which can give you exposure to either the Nasdaq or the S&P 500 or fund of ETFs. So if you want to participate through into the indices, that's also now possible sitting out here. Rather than investing into funds. So that's the easiest way. The flip side of course, is that when you do through LRS, you have many more options as compared
You
to.
you can invest in mutual funds also through the LRS route. So, for
Yeah, yeah.
example, if you want to invest in, let's say, a Vanguard fund or a Fidelity fund, which are not otherwise available in India, you can still do so through the LRS route. That's what you're saying.
Absolutely, you have far more options there as compared to feeder funds out here. But having said that, uh, I mean, if a normal investor is investing, I think it's good enough to start the journey. You don't want to necessarily look for the biggest universe out there. There's enough options available here. Uh, there have been some challenges recently in terms of the limits being exhausted by the mutual fund industry for overseas investments. But maybe it's a matter of time when this limits may be increased. But by and large, yes, I think investors, everybody should explore the domestic feeder funds definitely.
Okay. Basic question, Umnesh, is something that I'm sure all our readers would benefit by knowing minimum holding period, Umnesh, that you recommend to your investors. When you, because there's a lot of a tendency of people over here to buy sell buy sell buy sell. I mean, it's a universal tendency. I'm sure you'll agree. But as far as when it comes to international investing, when you're doing so much of research of markets that are otherwise not very as well known to you as the Indian markets, and after all of that, if you're shortlisting and investing and then investing your money abroad, what is the minimum time frame that you feel we must stay invested in them to get the most out of
I wouldn't look at, you know, equity investing, and when it comes to international, anything less than 3 to 5 years,
it? Okay.
because you need to go through market cycles. See, one thing is that we always have this recency effect, Kaizad. Markets have done, supposing markets have done very well in last 1 year or 2 years. Like for example, in the pandemic period, suddenly markets zoomed everywhere, and even the US, etc. And that recency effect tends, people tend to extrapolate that. You start thinking that I can make my quick buck in 3 months or 6 months, but that does not last for too long. Your whole purpose of investing internationally is to diversify, whether on the equity side or fixed income side, or overall an asset allocation perspective. For that, your portfolio will go through the variance in the market, the vagaries of the various asset classes, markets, etc. And as long as you have diversified, whether even within equities, as long as you have diversified, it makes sense to, according to me, hold for 3 to 5 years. You could have one bear cycle, one bull cycle, etc., and ultimately you will earn a healthy return over the medium to longer term, without necessarily having to worry about without having to look at your portfolio every 2 months or 3 months whether it is up or down. So I think investors should take that approach and try to build wealth over the medium to long term rather than looking at short-term trading opportunity. There are enough trading opportunities available in the domestic market. So if one wants to trade, there's a lot more information available. The other problem is investors will not have the necessary information readily at their disposal to take really short-term calls. So which may be more available in domestic market. So I would suggest a medium to longer term horizon.
Okay, okay. How important is the tax implications, Unmesh, when you are investing abroad? You have to disclose your investments, you have to disclose your income, right?
Yeah, so I mean that is one advantage that you have with the feeder funds out here, because they're all domestic. This is not remittance outside. But having said that, when you do LRS investing, you are obviously opening the necessary offshore accounts, and it's absolutely paramount importance, and obviously now mandatory to disclose any sort of bank account or any custodial account that investors will have. You underlying maybe shares, underlying maybe mutual funds, ETFs, no matter. I mean, you might just think it's a simple mutual fund investment. What's there to disclose? No, you are required to report to the tax authorities. In the income tax form, you have schedule for foreign assets, foreign income, dividend income, or any interest income which has been received from securities. So all those need to be disclosed annually in your income tax return. And I think that's the best way, because you just when you are investing globally, the last thing you want is any regulatory or any tax headaches. The other thing I would also like to point out here, apart from tax, since you raised the importance, there's another important thing is also to take care of regulatory restrictions. So there may be certain things that you are allowed to do under LRS, certain things that you are not allowed to do in LRS. For example, you can't leverage uh,
Okay.
in your LRS portfolio. You can't be leveraging, you can't be borrowing, let's say, and creating a liability. Secondly, even when it comes to uh, unlisted investment, etc., there are restrictions on doing direct unlisted investments. Now this whole ODI OPI regulation has come, so one has to be careful in what you do, and as long as
Okay.
you are
Okay.
following the regulatory and tax norms, I think one should be okay.
Okay, okay. Unmesh, very quickly, last two questions. We're running out of time. I must ask you your favorite destinations, your favorite themes, or your favorite indices, your favorite investment options abroad right now at this moment. What are your personal recommendations?
Yeah, so uh, obviously, when you look outside India, it is for growth.
Yeah.
I mean, because here fixed income returns are far higher. I wouldn't, my personal money, I would not invest outside for fixed. But having said that, by the way, I mean, if somebody has a conservative allocation, also right now the fixed income returns also in the US, etc., are very attractive. The whole yield curve
Okay.
has shot up all this. So if one has scope for adding fixed income, definitely the even the shorter yields, 2 year, etc., upwards
Okay.
of 4%, etc. I think
Mhm.
that's a fantastic yield to get without taking any credit risk. But otherwise, I would stay largely with the US markets, and I think there's been a lot of selling which has happened now. Obviously, we don't know. It's anybody's guess as to when the markets will bottom out. But I think US has a lot of opportunities, growth opportunities, value opportunities as well.
And it's
So
always better to also get into a market, that is, where everybody is getting scared. I mean, that's the time when you actually get some good valuations, although you're going against the tide. And it sounds very
yeah,
opposite of what most of the people are doing. But yeah, it's a good time to sort of pick up some
yeah.
diamonds in the
So
dust.
so I mean, right now, obviously, I mean, generically, US gives the best opportunity overall. But there may come a time. Say, for example, right now, the dollar has been very strong, and it has been in a structural bull market for quite some time now. Somewhere when it peaks out, let's say when you're closer to the end of the interest rate hikes, maybe if the dollar takes a breather, and that's when maybe some of the emerging markets, the flows, etc., to emerging markets may start picking up. So that also could give an opportunity. And the way I would do it is, like you do invest here domestically, we all do SIPs, systematic investing. I think that's another good way of, maybe may not have an SIP program necessary. You can have it in feeder funds out here, but globally, keep investing regularly. There's no perfect day or perfect month to invest. You benefit both from I mean, not having to time the markets. Uh, uh, you're investing across time periods in the markets itself. Plus, you get the actual dollar cost averaging. I mean, because the currency is also variable, right? Here, many people ask us, for example, is this the right time from the dollar rupee perspective? Is the right time to invest, send money outside? Well, even there, you benefit from doing staggered investing. But otherwise, there's a wide, I mean, I would look at a
Yeah.
bit of mix of
Yeah.
growth and value, because as the economies do better, maybe some of the value cyclicals also will start doing well. So I would keep a healthy balance between the two. I will diversify sectorally, not just because during some periods the Nasdaq 100 or so may be outperforming. Uh, I would actually diversify across some of the advanced, companies, etc., but also the traditional, the S&P 500 type of, and diversified across sectors and themes. I think that's the best way to extract maximum risk adjusted return over a longer period.
Okay, okay. Thank you, Unmesh. Thank you so much. I was going to ask you one more question, but I think you've answered that question obviously already. The do's and don'ts of investing in international investing. But I think, Unmesh, you have more than able to You've been more than clear about answering that particular question. So thank you
I will
so
just
much
say
for
one
your.
last thing. I
Yeah,
will just say
yes,
one last
yes,
thing,
yes,
Kaisa,
Unmesh. Yes, Unmesh.
that
Go on.
avoid the temptation. In the don'ts, I would say avoid the temptation of comparing global returns with Indian returns. So that's
Okay.
what we even right now. I see a lot of people saying, "Oh, India's outperformed." India. If you take that as a benchmark, the Indian market, then you will never be a good global investor, because there will be periods when India will outperform. But as I said earlier, there are many periods over which global markets have outperformed. But don't compare. It is diversification.
And that's the point of diversification, right? Because that is why you diversify. When one asset class is not doing well, that is why you diversify another asset class, which is hopefully not correlated. So, one goes up, one goes down. And that's exactly the point, Unmesh. You've rightly put it. And let's end this discussion on that note that, you must diversify across asset classes. You must diversify across India and international investing, and do not compare the two markets. So thank you so much, Unmesh, for your valuable insights. I'm sure our readers would have benefited a lot from listening to you. That's all, folks, we have for you today at Money Control. Do keep logging on to Money Control for more news, views, and updates. Thank you.
Thank you, Kesat.